Hello and welcome to the lecture for Chapter 13, where we cover corporations. So in some ways, corporations are more complicated in terms of shares of stock and different things we have to do from an accounting perspective, but in some ways are also a little bit easier than other kinds of organizations. Like with partnerships that we talked about last chapter, the biggest difference is the equity section. So the normal things that we do, like providing services and increasing accounts receivable or payroll or any of those other kinds of buying inventory and selling it, all of those kinds of things are the same as any other business. It's really the equity transactions that are different. So in this portion, I'll talk about the nature of corporations. I'll talk about the stockholders' equity section. We'll talk about paid-in capital from issuing stock. And then in the next section, I'll get into dividends, which is how we reward owners for their ownership. I'll talk about treasury stock transactions and then how we report stockholders' equity. Stock splits we don't have to talk too much about because there isn't much to do from an accounting standpoint for that. So over 90% of all U.S. business revenues are earned by corporations. So most of you will work for corporations at some point in your life. And until I started teaching and worked at SBSEC, a state agency, every organization I'd ever worked for had been a corporation. So a corporation is a separate legal entity. So it can buy and sell shares in its own name. The key difference here from other kinds of organizations is the liabilities for the owners are limited to their investment in the company. So there's now a wall between the corporation's assets and liabilities and those of the owners. So if you invest in a corporation, you're not placing your personal assets at risk, only the investment you've made. So a corporation can sell shares of ownership that are called stock. The ability to sell shares of ownership means that it's easier to raise money and it's easier to transfer your ownership later. The stockholders who own the stock own the corporation and control the corporation. So public corporations like Tesla and Apple and Ford Motor Company and those kind of big companies that you hear about on the news are companies that sell their stock on public exchanges like the New York Stock Exchange and NASDAQ and those kinds of exchanges. So there's heightened requirements for those kinds of companies in terms of reporting financial activities and being transparent about how they run their business. The reason for those regulations is to protect regular investors like you and I from being swindled out of their investment. Private corporations, on the other hand, are also called closely held corporations, are just owned by one or a few people. When I owned my company with my wife, Big Toys, she owned 50% of the stock and I owned the other 50%. So that was a private, closely held corporation. So you may have had a desire to own a share of my old company, but it wasn't for sale, so you couldn't have done that. Here's where you have to be careful as you kind of move up in your career. If you're ever offered shares in a private corporation, it's really important to recognize that they often have restrictions on them about who those shares can be sold to. So if you're given a 5% ownership interest in a company, that's all well and good, but it's an illiquid investment, meaning that you can't resell it or get your money out of it when you want to. So that there's some drawbacks to that. A corporation is a taxable entity, unlike sole proprietorships and partnerships. So a corporation files its own tax return. That's the big downside to corporations, that there is double taxation. So a corporation is going to pay tax on their income, and then whatever is left could be distributed to the owners, and that distributed income is also taxed as dividend income on the owner's tax returns. So the hierarchy in a corporation is that stockholders are on the top. So if you own 50% or more of a company, you control that company. So stockholders vote on their shares to elect a board of directors, and it's generally one share equals one vote. So the people that own more shares have more say in who the board of directors are. Board of directors are usually a small group of outsiders that are professional business people that have a lot of experience and knowledge about business, and they effectively say, I think the company should be run in a certain way. And they release statements about that if they're running to be on board of directors. And then at an annual shareholders meeting, the stockholders will vote on who they want the board of directors to be. So the interest of shareholders or stockholders, those words are synonymous, are kind of brought to fruition through the board of directors. The board of directors will meet and they'll take on the big decisions of the company, like should we sell the company to a competitor, should we buy a competitor, should we expand internationally or get into a whole new line of business. Those kind of very high level decisions are made by the board of directors. It's the board of directors that hires the CEO and the other top officers in the company. So if you think somebody is a CEO of a big company, they don't have a boss, they do have a boss. It's the board of directors, and that's who they report to. That's who could fire them. The officers of the company then hire all of the other employees within the company, so the senior management and supervisors and on down the line. To form a corporation, that's done by filing an application of incorporation with a state. It's very easy to do. The fee is very small. The state will then issue articles of incorporation to that entity saying you are now a corporation. You can choose to incorporate in any state you want, and the laws are different in different states. Delaware has very favorable laws that for corporations, and so there are actually more corporations incorporated in Delaware than there are people that live in Delaware. So you could, your business could be located here in Olympia, you could do all your business here in Olympia, you could be a Delaware corporation. I've been in companies that have done that. So once you receive the articles of incorporation from the state, you're now a legal entity and you can operate as that entity. Then the board will meet and they'll adopt a set of bylaws. That's kind of how the corporation is going to be managed. How many board members will there be? How will they be elected? Are their terms staggered or they all get elected at once? How often do they meet? All of those kinds of questions. The stockholders' equity section of the balance sheet is different for a corporation than it is for other kinds of entities. The stockholders' equity portion of the balance sheet for a corporation is composed of paid-in capital. That's money that stockholders have given to the company in return for the initial offering of shares. So when shares are initially offered, the money comes into the company. When shares are bought and sold later, the company isn't involved in those transactions. Those are between individual investors. So the company isn't recording those kinds of transactions other than noting who the owners are. But the initial investment, that money is called paid-in capital. The other portion of stockholders' equity is retained earnings. Those are all the profits that the business has earned to date for its entire life, less any earnings that have been shared back with the owners. That's hence the word retained, the earnings that have been retained within the business. So retained earnings are going to increase with net income. They're going to decrease when we incur a net loss or if we pay dividends. Dividends are equivalent to draws that are paid in a sole proprietorship or in a partnership. It's money that's taken out of the company and provided to the owners. That's what it's called, a dividend in a corporation. So when we close out our accounts, and I'm missing the word accounts there for expenses, sorry about that. When we do the closing process at the end of the year, we'll debit revenue accounts to clear those temporary accounts. We'll credit expense accounts to clear those temporary accounts, and the difference is going to be a credit to retained earnings if revenue is greater than expenses. It'll be a debit to retained earnings if expenses are greater than revenue. So companies paid in stock there are a couple of levels that we need to talk about. One is the number of shares that they are authorized to issue. So the board of directors will say to a company, you're authorized, management's authorized to issue 1 million shares of stock, as an example. That just means that the management can issue that many shares and receive money or property from different people for those shares up to that limit before they have to come back and ask for permission to do more. The level below that is how many have actually been issued. So how many shares have they've received the money and issued the shares to an individual. A smaller amount might be the outstanding shares. Those are the shares that are still in the hands of shareholders or owned by shareholders. So the difference between issued and outstanding would be the number of shares that the company has bought back. And I'll talk about that in the second part of the lecture for this chapter. Most states have laws that require shares of stock to have a small par value associated with them. That creates a level of legal capital that the company can't go below in terms of dividends. So it's set up so that you can't start a company, borrow a bunch of money, take that money, pay it out as dividends to all the shareholders, and leave the creditors hanging. So par value is the amount of capital the company is required to keep in the company and not pay out as dividends. So in that case, it benefits or protects the creditors. So shareholders have some rights. They have the right, like I mentioned earlier, to vote on corporate matters, usually through the election of board members. They have a right to a share of the profits, okay, and we can talk about that at some level. And then they have a right to a share of the assets if the company is liquidated. So in terms of journal entries, when we issue stock, it's usually at a premium. It's usually above par. In fact, legally, you can't issue stock below par. So in the first transaction there, we issue preferred stock, and I'll talk about that in a minute there. We offered that at $55 per share. It had a par value of $50. So we received $110,000. We issued those shares of stock, so we credit preferred stock. We always are going to credit preferred or common stock for the par value of those shares. That's $100,000. And then we credit paid-in capital in excess of par for the difference between the $55 we issued it at and the $50 par value. So we credit paid-in capital in excess of par for $10,000. So that first transaction there, the paid-in capital is $110,000 on that transaction. The second transaction involves common stock, and in this case it's $10 par common stock, and we issued it at $12 per share. We received land, so it's not always cash that comes into a business. It could be assets that come into a business, or services, like it could be organizational expense if we give a lawyer shares of stock to file our articles of incorporation as an example. In this case, they received land worth $120,000 and they issued shares of stock in return for that. So as I mentioned, there's two different shares or classes of stock, common stock and preferred. A lot of companies don't have preferred stock, they just have common stock. So if it isn't mentioned at all, then you assume that it's all common. The difference between the two, as you can see from this graphic from the textbook, is that the preferred shareholders are first in line to get money for dividends. So when dividends are paid to the shareholders, they're paid first to the preferred shareholders, and then whatever is left over is paid to the common shareholders. So they're different. Usually preferred stock doesn't carry voting rights. So and the dividend rights associated with preferred stock are either going to be described as a dollar amount. So it could be $1 per share is the dividend, or it could be a percentage. It could be 10% of the par value of the preferred stock is paid out as a dividend. Preferred stock is also described as being cumulative or non-cumulative. What that means is if it's cumulative, it means that if the company has a bad year and they can't pay out dividends that year, that they still owe those dividends to those preferred shareholders. And the next year, if they do have enough money to pay dividends, they first have to pay the dividends in arrears that they missed to the preferred shareholders in the previous year before they start paying new dividends. So that's what cumulative means. Non-cumulative means if we missed a year, then it's too bad. You're not going to get that money later. So that's the end of the lecture for part 1. I will talk to you again in more depth about dividends in part 2 to the lecture for this chapter. Thank you.